What's up everyone, this is Kenny here from Property Stories. So as we all know, next month we are going to the new reference rate, which is standardized base rate or SBR. Actually it's just next week as I'm recording this. So what is this SBR all about and how it will affect all of us as consumers? Before we go to the SBR and what's its explanation, perhaps it's best we go back to right at the beginning to understand what is this terms called the reference rate. In short, a reference rate is a benchmark rate that is used to price all the banking products. Yes, includes your deposit, alright? How much to charge to pay you, the depositor, for your fixed deposit, or how much to charge for your loans that you take with the bank. Example, housing loan, personal loans. We use these benchmark rates. This is what the banks do to price their products to you. So prior to this, we are using base rate. We are still using base rate now, where every bank's decided a different rates. Come to 1st of August 2022, we will be moving for individuals only. For individual borrowings, we will be moving to standardized base rate or SBR. If you recall, this has been announced last year. At the same time, August last year, they announced that this year they will standardize the base rate to SBR beginning August 2022. This is not the first time the central bank does this. We have changed the reference rate 3 times as far as I can recall. I'm not that old. I first bought my property back in 2010, alright? So at that time, it was base lending rate or BLR. So prior to 2015, it was BLR. So from 2015 right up to 2022, it was base rate. BLR is a standardized reference rate, and now they use base rate. Okay, come next month, they're going to change to standardized base rate. So what is this new reference rate all about? This new reference rate, where SBR will actually follow the OPR. What this means is that all the banks will have the SBR plus the spread, and then they will quote you the effective lending rate. As you can see from the screen, the effective rate is actually SBR plus the spread. SBR here is the OPR again. So the OPR right now is 2.25. So SBR is 2.25, is uniform across all the banks. The only thing that changes will be the spread. Okay. These new rates are applicable to all your floating rate loans, like for example your housing loan, sometimes personal loan as well. Personal loan, there are some floating rate that is taken on the 1st of August onwards, okay? To our individual borrowers only, companies are different. And these rates will also be applicable to your overdraft. If you have an overdraft facility, overdraft facility is a review facility. This is a revolving credit that they review annually sometimes. Most of the banks actually review annually. Sometimes it's short, but we will go there later. But know that this SBR changes, will affect products like overdraft that is reviewed periodically. After 7 years, why do this again? Previously there's BLR, where it's uniform across all the banks. Now after 7 years, do the same thing again. Why come back to SBR? The central bank has actually found that it's easier for consumers to actually compare if the base rates are all uniform. If not, imagine this today, if you want to take a loan, you have to ask, hey, bank A, what's your base rate? Bank B, what's your base rate? Then you have to plus the spread and then see, it's very confusing because every bank has their own base rate. What will happen to your existing loans? Your existing loans, if you are under BRR or BR currently, it will have no change, okay? You will still follow that same reference rates. These changes only applicable to new loans. So, if the OPR move, BRR, BR, whatever it is, also will move. And this will mean that your installment will increase and decrease accordingly, okay? The only time that it will change is when you sell the house and you take a new loan, or you refinance the house. If you refinance the house, you will be subjected to the new reference rate, or refinance a commercial property because it's under individual borrowing, it will be subjected to the new reference rate, SBR, standardized base rate. With that being said, what's going to happen to my existing loans? Are they going to convert it to SBR? No, the answer is no. If your loan is under BRR, you follow BRR. If it's BR, you follow BR until it's fully paid. Or, of course, you refinance after 1st of August. Then you are subjected to SBR. If you are borrowing under individual name, you will be subjected to SBR. Doesn't matter what property it is. It can be a residential or commercial property. I'm sure the next question, or is on everybody's mind now, is, will I be paying more? Already things are increasing in prices. I don't want to pay more for my housing loan. Good news to you, you won't be paying more. Okay? The banks will still quote you the rates based on effective lending rate, regardless of the reference rate that is used. So if OPR increase or decrease, your installments will increase and decrease accordingly. If you need more information, I highly suggest you go into the Bank Negara website to download this brochure that they have. It's very clear, very colorful, very simple, explains everything that you need to know about this new reference rate that is coming next week. A link, if you want to click, is right up below in the description. I suggest you download and read, okay? My personal take on this, let's just say my personal take on why the central bank choose to revert back to a standardized and uniform base rate for every one of us is due to this. Number one, yes, it's very confusing. A lot of banks, all different base rate. And second, right, once the competition kicks in, if you notice, right, the rates, if you compare in the banks, right, at the end of the day, the competition will bring the rates out roughly around the same. It's like 0.05, 0.1 difference. Of course, I'm just talking in general, but it depends on your profile. Okay, so what's the point of having every bank having a different base rate? Why not you just standardize? Because since you're going to compete anyway, and you're going to come out with roughly the same interest rates, might as well the central bank take it back and make it easier for everyone. The next one is the impact on the earnings of the banks. Previously, when you see base rate, right, you can see every bank has a different base rate, then you can see a different spread, right? So we recall that this base rate is also the part of the cost of funds. And you can see the lower the base rate is, the lower the cost of funds. What happens if the central bank actually decides all the reference rate? What will happen is that the bigger banks, which has lower cost of funds, is lower cost of operation because of economics of scale, they are expected to earn more. And the bank definitely will be able to roar, just like this animal on this picture right now. This bank will definitely be able to roar. So if you are thinking of investing, getting some dividends, perhaps you can consider getting the big banks and keep, because banks are still the darlings of dividend investors, right? So I leave it to you. At the end of the day, do your own research and make your own judgment. This is Kenny here from Probably Stories. I'll see you again in the next video, and see you in the SBR era. Bye bye.